Hi, everybody, and welcome back. David Robertson from the Financial Center once again to just share some thoughts with you. Here we're going to talk about welcome to our annual State of the Markets meeting. That's where we take the time to go back, look at where we've come from, where we're at today, and kind of where we might be for the year. We also take a look at all of those predictions that all the pundits had from last year and see how they did. Well, I'll let you take a moment here to go through the disclosures and read those carefully on your screen. And then we're going to jump right into see how those all those strategists, all those pundits did for last year. Well, you can see from the screen that they predicted that we would end up the year at 3,800 on the S&P, about 20% less than we actually did at 4,800 about. And there are some reasons for that. If you recall, at the end of 2022, everyone was concerned about the recession that was for sure going to happen, but it didn't. We knew that we were in for some carryover from all of the interest rate hikes that we had in 22. But what they didn't count on was AI, artificial intelligence, and how that just jumped up in the marketplace. And AI seemed to be the theme of the year last year, as many of those companies soared significantly and no one expected. You may or may not have recalled from some of the things that we talked about last year that markets are unpredictable. You cannot predict markets or economies on the short term. Long term, yes, we know where they'll end up, but in the short term, it's a fool's errand. So they got it wrong. There were some reasons for that. Now, let's take a look at the chart in front of you on the S&P. And how did it go for the year? Well, as you can see, starting off on January 1st, markets, much to everyone's surprise, jumped right out of the gate. They did quite well. But markets are emotional and they're fundamental. They move long term on fundamentals, but in the short term by emotion. And I'll take you through some of the emotion that happened last year. Markets jumped out, as I said. Corporate earnings were good. Everything was good. And the Fed said, nope, we're going to keep our pedal down and we're going to increase interest rates again. So they did. Markets don't like that. They sold off, as you can see. And then markets started to do well. Corporate earnings were doing well. There was still some doubt whether this recession was in fact going to happen. And they climbed that wall of worry. And then you see from the chart that markets get up there and they still keep growing. The Fed, meanwhile, keeps its pedal to the metal, if you will, even though we saw inflation hit a low. During this time last year, we saw inflation coming down, but it was the Fed's rhetoric, Jerry Powell saying, no, we're going to keep interest rates higher for longer. Well, you can see that they did that in about mid-year. Markets trended down, sold off on that. And we saw treasuries hit a high rate because they were expecting that Fed Powell was going to be true to his word and keep interest rates higher. But markets do what markets do. They went down and they climbed that wall of worry. And Jay Powell, later on in December, came out and said he was a much kinder, gentler Fed chairman and said, maybe we've got this thing under control because inflation was coming down and we all knew that. And he said, maybe we can decrease interest rates next year. Markets rallied on that. And as you can see, in December just took off. November and December markets, the S&P was up about 12% in that short period of time. Well, where are we today? I want to go back to where we were in 2020, because in 2020, as you can see from our indicators, the outlook for the next 6 months was mixed, much as we have today. And you see that inflation was not even a concern at the time. We were not being threatened by inflation. Folks, I bring you back to what I said before. Markets are unpredictable and unknowable in the short term. Didn't know that we were going to have a 40-year inflation spike. Now let's take a look at what it looks like here in December. December, things were looking a little dour, and there were good reasons. We expected that recession to be there, but it never came. Or maybe it didn't, we just didn't know it. But markets are much more resilient than anybody ever imagined, and we had a surprise to the upside. Here we are today. About January 2024, you can see there's caution. Many of the market indicators are neutral. We had a big run up last year at the year-end rally, and so far markets are just kind of digesting that whole theme. And of course, we have an election coming this year, which we're going to talk more about that later. Okay, let's take a look at and see how, in fact, inflation did. Well, you can see that inflation is still trending down, as some of us suggested a year or so ago that, yeah, we would see that 2 to 3% again. It was just going to take a little time. Well, today, as I speak, we're at about 3.5%. And next year at this time, we could hit the Fed's target of 2%. We'll see whether we do or not. Let's take a look at the deficit, some of the headwinds that we might be facing this year. I've had many people call and talk and say, oh my gosh, the Fed spent all this money. That's true. Okay, they have. And we've been here before. You can see from the chart, the blip, that in the big peak there, or the previous peak, was World War II. We were spending more than we were bringing in GDP for the economy was generating. But that was a war. Well, we paid that down. Paid it down until 2004. Some of you may or may not recall, then President George W. Bush said, yeah, we have a surplus. We have a surplus and we can reduce taxes because we are now taking in more than we're spending. Well, that didn't last long, because you can see the 2008 with the TARP programs and the money that they threw at the economy at that time caused that big spike. Then we thought that was a lot, but then COVID came along and they threw trillions at the markets. Well, we are now back to that point where we're spending more than we're taking in. And folks, this is not sustainable. Something will change. We've had this before. We've paid it down. What happens? Don't know. But I do know that the next administration is going to be the ones that are going to have to deal with this, have that on their hands. Let's take a look at consumer confidence here on this chart. Consumer confidence is an indication of what the market may do. Now, you might think, yeah, people are feeling good. Yeah, that's a good time. No. It's just the opposite. When people are feeling good about the economy, that's a bad time to invest. When people are feeling terrible about the economy and it's the end of the world, that's actually, folks, the best time to invest. So we can take a look at some points here. January of 2000, you can see, oh my gosh, that the investor confidence was great. But what happened after that? Down years. And you can see that from where we're at on the chart, that go to February of 2020. February of 2020, everybody once again was feeling great about the economy. We'd come off some great years. Sentiment was good. And there it is. COVID hits, markets go down a whole bunch, and these are numbers on the chart, are consumer confidence, not the markets, but consumer confidence was way down. Okay, that was April. What happened after that? You can see by the chart, markets take off. And then something happened last year in about June. We hit an all-time low for consumer confidence. Why? I don't know, but I had many of the strategists that Tim and I work with are pounding the table saying, this is a great time, but yet nobody wanted to put money in. So where are we today? We're kind of in the middle, doing fine. We'll see. Not too high, not too low. We'll see what happens with consumer confidence from here. Unemployment. This unemployment is once again a good thing that's in our favor because we don't have enough people to fill the jobs that we have open. What does this mean? Well, it means that the job market's going to be a little bit tight. If we do get a recession, it's going to be very mild. Why? Because things will tick down and people will get right back to work. There will be a shift. And you recall, recession is just like winter time in Michigan. It's cold, it's ugly, it's dark, but it always ends, and you get 3 good seasons for 1 bad season. So that is something that's really in our favor as well. Let's take a look at rates, the Fed and interest rates. The Fed this year, Fed market said that they are going to reduce. They've already telegraphed it 3 times this year, is what they said. Market believes it's going to be closer to 5 to 6 times. Interest rates going down means that's generally stimulatory for the economy, which is a good thing. Well, whoever's right, and we'll see at the end of this year, but the long term is that in 2 years, interest rates are going to be down to about that 2.5% to 3% range. So that's good. And what does that mean? It's bad news for CD investors, okay, quite frankly, because those CD rates have peaked. But this is really good news for stock and bond investors and planners, because you can see from this chart that this is the good news. If you look at that little diamond on the chart, that's historically at other times when interest rates have peaked. And we know that today interest rates have peaked. Why? Because the Fed's told us that they're already going to start reducing that. So if those 5% rates that you may have seen, that's it. It isn't going to go any higher. In fact, it's going to go lower over the future. But take a look back at all of those times in history where we've seen interest rates come down. And when you see interest rates come down, for example, in '84, take a look at the blue portion, because that's just a moderate portfolio. In that case, stocks were up 30 the next 12 months. Bonds were up 24, and a mixed portfolio diversified was up 27. I'll take that. And then in '89, diversified portfolio up 16, 94, 30. Yep, there was the 2000s where things went down. But then in 2006, more recent history, where things were up 27 and 22 in 2018. In either case, folks, I like our odds for the next 12 months and moving forward after that. Let's take a look at some potential headwinds. What are we? Well, inflation. Put that as a headwind because even though I told you inflation is coming down and has been, the Fed is still very much concerned that we could have a reignition of that inflation and it take back off again. So could happen, but not real big headwind. Fed policy. What if they do a turnaround and they say, oh, we told you we were going to decrease interest rates, but we changed our minds? That will be a problem for markets. Corporate earnings are absolutely a headwind, and that is that we don't know where they're going to be. People had a ton of money from all the COVID stimulus, but that money has run out. And will they still spend and allow corporations to still make the profits? New competition, that is Are people going to say, oh no, these 5% CD rates that we have, I'm going to take everything and put it into CDs because they believe that these are going to be here and be safe? All of you folks, I have just taught you and shown you that that is not the case, that they are not safe, certainly not against inflation. But market returns could be much better. Is there going to be a recession? Well, I told you, there probably will be. But if we do, it's going to be mild. Geopolitical tensions are always there, and they're always a wild card in the mix. Let's take a look at some potential tailwinds, some things that could work out very nice for us. Well, moderating inflation, which is where I think we are. Inflation continues to moderate. Fed policy, they continue to reduce interest rates. And as you've seen, I've demonstrated from some of the graphs, that's very favorable for stocks and bonds. The advent of artificial intelligence, AI, being integrated into many of the companies is going to be a game changer over the next 10 to 20 years. But it doesn't happen overnight. What if profits are higher than the expectations? Big tailwind for markets. And the Fed, the dovish Fed, they come down more than we expect. That's good. China's been a bit of a wild card. If they stop being a bully to some of their neighbors and they get their act together a little more economically, that is a good thing, a tailwind for our thoughts. Let's take a look at valuations on the S&P. The valuations on the S&P, that's what do we pay for a stock? Well, we've just seen markets go up. So that means all those prices have gone up. Some companies far more than others. And those of you that have been in have heard me talk about the Magnificent Seven and the difference between growth and value. So, although stocks you can see from the chart are fairly valued today, there are some stocks, some companies that have had extraordinary run-ups and are quite frankly very expensive. Those are the ones that we'd really rather stay away from for the future until they start to come back down to earth. So stocks are in a pretty good place. Let's take a look at the forecasts. Well, where are we? I showed you that chart in the beginning where everybody was, and they thought that the S&P was going to end at 3,800 for the year, and in fact ended up about 4,800. They missed it by 20%. Dave, how can they be so wrong? Well, they're predictions, and sometimes, quite frankly, things happen, and that was a surprise to the upside. A lot of that came from artificial intelligence and inflation moderating quicker. So here, you can see from one end of the spectrum to the other that there is a wide dispersion. Some folks believe that things are going to be up about 9% for the year at the end of this year, and yet we have some other folks that believe that it's going to finish at -12. Well, as Tim and I have talked, somebody's going to be right and somebody's going to be wrong. Don't know. And we don't invest in what other people think. We build portfolios to help people to get to where they need to get to, knowing that, in fact, sometimes markets are going to be up and sometimes they're going to be down, and we are prepared. So we'll see what happens. Let's take a look at the long term and, hey, when things go up and down. I want to take you back to 1996. 1996, the S&P 500, that's that marker for America's greatest companies, the market. The market stood at 741 to be exact, okay? We went through the late 90s where we had a great run up leading up to 2000. S&P went from 700 to 1,500, just about doubled. man, oh man, for those of you that were with me during that time, that was a great time. Happy days, Y2K. We thought things could never get bad again. Remember about the investor consumer sentiment. Things were good. What happened? Markets went down. Markets went down back to about that 700, but then once again, markets do what markets do. They climbed back out, went up to 1,500, and then we had '08. Oh my gosh, markets go to 677. It's terrible. Markets would never recover. People told us that we would never build homes again for 12 years. And guess what? They were wrong, because markets do what markets do. It went from 777 to 3,400 on the S&P. Holy cow. Then, well, we dropped back in COVID. Oh, it's terrible again. And then we go to 4,800. Oh, and it's happy days. And then we go to 22. Markets pull back. Oh, it's never going to be good again. And here we sit at almost record highs once again. So, folks, the moral of that story is don't count the market out in America's ability to innovate. America's greatest companies and their ability to innovate and move forward and figure things out in any kind of market. You've all seen this chart. Intraday declines. Every single one of you, I've given this out to you at our previously State of the Markets meetings when we did in person. I told you to put them on the refrigerator as a reminder that every single year markets will go down. That's the red dots on the chart. That the gray bar is how the market finished at the end of the year. But somewhere throughout that year, every single year on the chart, markets go down. Now, when they do, and it's the crisis of the day, because the media will always tell you this is the end. Go back to what Dave and Tim taught you, that, hey, when everybody else is feeling bad, that's a good time to invest. So you just be patient. Speaking of sticking to the plan, our next slide talks about the value of discipline. Well, value of discipline, quite simply, you stick to the plan, got a pretty good chance of getting to where you need to get to. Doesn't happen directly over the first year, but of all positive returns, there's about a 70% chance for a 1 year, 12-month, that you're going to end up in the green at the end of the year. After 3 years, okay, that goes to higher, 77% positive returns, okay, or an 80% chance. And then you take that to a 5 year, you're at about an 80+% chance that you're going to be in the positive or do pretty well. And then a 10 year, it's 90, almost 95%. And there's never been a 20-year period in history where people have lost money in markets. So, makes sense to stick to the plan despite the fact, or in our phrasing that we say is being on the road, sometimes there's going to be accidents and slowdowns. We know they're out there. So since we know they're out there, we do things to help to mitigate that risk, or the expectation that there's going to be an accident out there that we can't predict and we cannot prevent. How do we deal with those? Well, most all of you know that we built protection into your portfolios. And that protection has worked out quite nicely over many of the time frames, especially in 22. Other way is by diversifying your portfolio. You can see that the chart of asset class returns simply shows this. Hard to pick what's going to be number one every year. Dare I say impossible, because markets are unknowable and unpredictable. But if you stick to the plan and you own a diversified portfolio, you're never going to be at the top, but you're also never going to be at the bottom. And if you do that long term, you're going to be just fine. And that's how most all of your portfolios are allocated, to be a diversified plan. Next, I told you I was going to come back to this, and we were going to talk about the elephant in the room, or I shouldn't say the elephant and the donkey in the room, and that is the presidential election that we got coming up, that I'm certain that everybody out there is looking forward to. No one is looking forward to it. But somebody is going to end up being elected. Well, I often go through this with people, and they tell me every single year, Dave, if that guy or that person gets elected, I'm going to take all my money out of the markets because things are going to go down the tubes. And the other half of the people say, Dave, if that person gets elected, I'm taking all my money out because I know things are going to go down the tube. Well, folks, I've said this many times before. Markets can live with Republicans. They can live with Democrats. They can live with war. They can live with peace. They can live with high inflation, low inflation, high taxes, low taxes, but they can't live with uncertainty. Well, come this November, we're going to get certainty. Might not be the certainty that you want or that I want, but we're going to get certainty. And when we do, markets move forward. What does that mean, Dave? It means this. See this chart? As you can see from the chart, that the blue is straight Democrats, the Democrat president, and you have a Democratic Congress. Markets go up at 15% on average since 1950. If there's a Democratic president and a Republican Congress, well, that's 18.5 on average. If you have a split, that's 12. Okay. And then you have a Republican president, all these time frames, okay, with a Republican Congress, things are up 10.5. Democratic Congress, Republican president, 7. And if it's split, 17.5. Folks, I would suggest to any one of you that I will take any one of those numbers. Okay, they're not bad. So don't fear what the press, the media would force you into thinking. Nope. Either way, markets will deal with it. America's greatest companies will continue on. So, what's next? Let's take a look at steps for you to take. Well, as always, keep us informed. Let us know if things change in your life. That's what we're here for. Tell us if you've got any concerns about stuff. Let us know, or maybe we can help. And make sure you keep your important documents up to date. I shared in some of the past videos that unfortunately we've had to say goodbye to some of our dearest friends and help them. But it's gratifying to help to transition those assets to the next generation. And it is always better when documents are up to date. It makes it easy. So folks, take a look at those things. If you have questions, give Tim or myself a call, and we're happy to go over there to help you out. What are the things that we're going to do? Well, we're going to do what we're always going to do. We're going to continue to do these videos to help to keep you informed, to talk to you. And these are our ways of talking to you when I am not there. Okay, we're going to manage those investments to how we've laid out in the plan, to that strategy that we've built for each and every one of you. And we'll do our best to still stay current with all of the things that are happening in the world and in the marketplace. So, with that said, hopefully this was helpful to all of you. Hopefully this is going to be a wonderful year to surprise on the upside. And but we don't know. We'll be here with you throughout the journey with whatever happens. If you have questions, give us a call. If you have friends that need to see this kind of information, please pass it on, shoot it out to them in an email, or forward one of those videos. Other than that, if you need us, we're here. Tim and I will be here to talk. And until next time, we'll see you soon. Bye now.